Hey guys, welcome back to the After Hours channel. I'm the 8-Tailed Beast, and today we're going to talk about risk management. We're going to look at the recent rally on the meme stock BBBY. So let's get into it. Why was there a meme stock rally? At the center of this rally, you had one person. His name is Ryan Cohen. Now, Ryan is a co-founder of Chewy. He is also known as the chairman of GME. What gives him the power to influence the stock price of Bed Bath & Beyond is he was the activist investor for Bed Bath & Beyond. This means his specialized hedge fund had 7 million shares worth of Bed Bath & Beyond. His total stake in this company exceeded over 5%. At this point, he falls into his own category, one of beneficial ownership. Whenever a person or a group exceeds over 5% stake inside of a company, they're required by the SEC to give a report on what they plan to do with their stake in that company. They call that the 13D. Now, filing the 13D is a requirement by the SEC. But at the end of the day, we're in a free market and everyone has their own personal edge. As long as they follow the rules and only use public information, no one gets in trouble. But recently, Ryan Cohen, he replaced the CFO and a few board members. So it's a usual tactic of the activist investor to start a proxy fight inside of the company. When they do this, it gives you a golden opportunity. So what sparked the retail rally was his most recent update in how he was planning to sell his stake inside of Bed Bath & Beyond. The way the information was misrepresented, it caused the stock to rise in price. Now, at the top of this rally, you had an update in information again with Ryan Cohen's intent to sell through file 144. This caused a plummet in the price by 40%. But then rumors started to circulate through Wall Street bets that Ryan was still in his position, and then it created a new high and re-sparked the rally. Everyone believed the stock was going to 100 plus, but in reality, Ryan Cohen actually sold his entire stake in the company. And then once the confirmation came out, the stock plummeted 60%. So at the end of the day, Ryan Cohen was supposed to be the savior, but in reality, he ended up being the poison pill that put Bed Bath & Beyond out of his misery. Finish him. So when dealing with the markets, it's a given that you're going to take a loss. That's where risk management comes in. We're there to manage risk, not to avoid it. With all the meme stocks out there, at the core, most of them are buying based off of emotion. And Wall Street bets, they're the symbol of you do what works. And what they trade with is blind optimism and persistence. They make it look cool to buy the dip, and they even give you an enemy to fight, which is the institutional short seller. Now, there's people out there that know of this information. They use it as their edge in the free market. And Ryan Cohen and other activist investors and politicians, when they spark a rally, they know what they were doing. So here you have Wall Street Silver. They make this advertisement so they can promote a stock. And when they pump the stock, is in this stock just to have fun. But others are actually a little more serious about starting a movement where they all have a fight the power mentality. The power in their eyes is institutional short sellers. And sometimes it's just short sellers in general because they just want to see how far they can get a stock to go up. Now, when you have people with money and large stakes in that company, like Ryan Cohen, the chairman of another meme stock, he knew that he had a cult-like following behind him, and he used them as liquidity to get out of his position that he made back in March 2020. Now, everyone didn't lose money on this, so we know Ryan Cohen, he pocketed $60 million, but he wasn't the only one that got paid. There was also a 20-year-old university student who raised $25 million from his friends and family. He bought BBBY at $5 and then sold it in the upper 20s and made $110 million. Now, the friends came from a hedge fund that he went to for an internship. The family was already wealthy to begin with. He was extremely shocked that the price went up so fast. Now, I can barely get $25 from friends and family, but this man got 25 million. Now, kudos to him for making the money, and to make things even better, after selling his shares in New York, he flew all the way back to Los Angeles just so he can make it to class. When it comes to risk management, the reason this college student sold at the top is because he said it felt like it was overvalued and it wasn't worth the risk at that time. When we talk about risk management, this is just another way for saying we need a strategy to minimize or reduce our losses. Risk management falls under several categories. You have risk avoidance, risk transference, risk acceptance, and risk reduction. So in trading, an example of risk reduction would be taking smaller position sizes. When it comes to risk transferring, this is transferring your risk via contract to a third party. In trading, this looks like your broker. The broker is willing to hold your risk, but as soon as you get past that point, you're going to be cut off because they can't afford to keep you there. So when it comes to risk acceptance, at a very basic level, you just understand that taking a loss is a given. The last one would be risk avoidance. This is pretty much saying you do not want to take any actions because that's the best action. An example of this would be your ex just called you after a couple years. You make a strategic decision. But there's also ghetto risk managements out there. One of those places that can give you an edge is your finger speed. Now, your finger speed in trading can help you minimize your losses, being quick to cover those losses, and also being quick to top tick a ticker. Finger speed in trading is underappreciated. To get top finger speed, you need to have discipline. You need to have good habits, and then those good habits are going to trade for you. So at the core of these meme stock investors, there is an emotional trader. At the core of the financial institutions, there is a logical trader.
All right, so we just got the new shipment.
Hey, is that my new cocaine?
This shipment has a lot of weak fundamentals, so we're gonna add it to the short sell list.
Oh, it's a short sell list.
You know, I take a second look. A lot of these, they affect the working class a lot. You sure you want to short sell these?
Come on, man, don't get emotional. You can't make money that way.
Hey, you're the boss.
All right, that's all I got for you guys. If you're trading in the free market, no matter how much experience you have, size of your capital, or your edge in the market, you need to have some risk management, because the longer you survive, the better off you'll be. So if you like the content, hit that like and subscribe button, and I'll see you guys in the next video. Peace.